TGIF. Happy Friday. Happy jobs report day. Let's dive into things. And I actually think we got some good, it is data intense, but I think it's good intel here. So today, rates apparently still stuck in that high six range. We unfortunately may be right. We're going to find out. But the last 2 weeks, you can see all this green on the right side. Remember, green is good for us. When this goes up, that means our home interest rates come down. So green has been good, but last week, so you count back 1, 2, 3, 4, 5, we were about where we are today. The concern we had last week was that we are facing a lot of what we call ceilings of resistance. So again, 5 days ago, and we're kind of there now, right around that brown line, that's the 25-day moving average. 5 days ago, we were hitting it, and then above it, you got the 100-day purple, then you got the black 50-day, and then you got the 200-day. Well, isn't it amazing how technical indicators work? The last 3 days, so this red one on the right, that's today, that's Friday. Look at Thursday and Wednesday. Wednesday, you shoot up to that 200-day moving average and you literally hit it and you don't move. And if you want, and then Thursday the same, and today, Friday, falling off it. And if you want more proof, go back 4 or 5. Look at that purple. We bust above the purple for all of like 2 days, but that black one then sends you back down, and all of a sudden you get tired and you're below all the lines, and then all of a sudden really good news comes out, or I guess technically really bad news for the economy. And then yesterday we had a really good run until Trump and basically U.S. and China started having conversations, and people were thinking that if they're talking, then maybe all this tariff stuff won't be as bad as they think. So that's why the stock market had a little rally in some parts of it yesterday. But today, the big one, jobs reports, and it hurt us. And that's why we're down red. So I do think for the immediate future, I don't think we're going to see better rates. In fact, I think we could drift higher and go back to higher rates here in the next week or two, just because, again, all these resistance levels, and I don't see any immediate good news coming on that's going to have us bust through all this stuff. So job reports came out, and basically payrolls are better than expected. They were initially 100, not initially, but they were expected to be about 125, and they came in about a 139. So okay, good, people got jobs, but I'm going to tell you why that's not so great for us here in a second. But the headlines makes everybody think, oh man, the economy is doing great, jobs are doing great, unemployment stayed at 4.2, which is super low. And that would seem good because obviously we want a good, healthy economy. However, that does not help mortgage rates. And you can see over on the left side, the third bullet, half the jobs, nearly half, came from healthcare, and then leisure and hospitality and social assistance. Why is that not ideal? Because when you figure this out, I mean, healthcare, that's a great profession, right? And that's been number one, and I'll show you that here in a second. Leisure and hospitality, typically you're talking, hotel staff and folks that help with the leisure and hospitality and maybe even, resorts, things like that, but those typically aren't the home buyers that you're going to see. It just, again, they're typically more hourly type employees. It is what it is. Social assistance, again, you're not talking high dollar jobs. So what's interesting to me is in the same, you scroll down too on CNBC, right after that job reports I just showed you, corporate layoffs have ramped up in recent weeks, and it's Walmart, Amazon, Microsoft, Procter and Gamble. These are big companies that are making cuts. So while the job reports numbers came out favorable, remember that looks back. It's backwards looking, and historically gets revised worse, and it's been that way for the last 2 or 3 years. It's been that way for a long time, in fact, but just especially, it's gotten incredibly ridiculous over the last year or two as far as how much these revisions are. Because when it's in the rearview mirror, people don't pay attention, but these are incredibly inaccurate stats. And in fact, the article on the right just shows how the Labor Department basically admitting to guessing, doing a whole bunch of guesswork when it comes to inflation. And this is the type of number that when it's zero point 0.1 off, or better or worse than expected, the market has big swings. And basically, they said they've understaffed, and the staff they do have to figure out, these inflation numbers are literally the qualifications are you must be 16 years old and have a driver's license. And so they're asking these 16-year-olds with driver licenses to go figure out all the what eggs they're selling for and all this other stuff to figure out the inflation. They've admitted they've had to extrapolate and kind of do guesswork on it. And the same goes for the job report. So it's amazing that these two biggest things, the jobs and inflation, because that's the Fed's mandate, is to keep jobs, keep jobs, meaning unemployment low, and keep and balance that with low inflation. Yet these numbers are just wild. So I mentioned earlier about healthcare and social assistance. You can see how many jobs, and this isn't the same data. This is from 30 days ago because the information I showed you just came out, so I don't have those updated numbers. But you can see how much of that compared to other jobs as far as a 3 month net change. Like these aren't typically high paying jobs. I mean, healthcare can be doctors and nurses and RNs and things like that, and that's wonderful. But again, a lot of it when it comes to the leisure and hospitality, again, this is lower because this is the old stuff. But the reality is like a lot of this stuff just isn't high paying up top. And so while the quote unquote economy is good, these aren't big spenders. And so it's just again, I'll be interested to see what these revisions look like. Interesting but sad stats. Debt, we've known it's been up. We know household debt's been in the trillions. Credit card debt's been over a trillion. I didn't know this total number. This was new to me. The total household debt is $18 trillion. I know credit card debt is over a trillion for Americans, and that's crazy to me. But 18 total, 18.2. And so what this shows is that we as Americans are in a boatload of debt. And you can see how much that debt just has skyrocketed since COVID. So, and if you'll also notice when you saw that kind of an increase back in 2003, in 2008, 7, and 8, mortgage meltdown happened, and all of a sudden things change. So, household debt, as the left one, is percentage of disposable income, meaning how much money do you have left over at the end of the month compared to how much goes out or how much you're able to save or goes out the door. And you can see that we are basically at parity, meaning people are barely making enough money. There is no disposable income. There is no disposable income for the debt. So we are literally just paying debts and staying right above just kind of where we have to be. Student loan debt, delinquencies gone up. And the reason why they were so freaking low is because there was basically the moratorium on payments. So now that those payments are coming due, that's why that super big spike is over there on the right side. It shouldn't be a big surprise, but it is kind of jarring to see that graph. Just what happened with the Biden administration. They put all the hold on all the debts, and I guess technically, COVID started that. So I'm not getting political, just saying what happened. But the reality is, now that people have to pay their student loans, it's no surprise there's delinquency. Here's the trade-off and the good news. So this is a selfish plug for mortgages. The good news is equity in homes is at a 17-year high, and I'm surprised it's not an all-time high because I thought it would be. But there is $11 trillion of tappable equity. So that, again, the reason why I stress the word tappable, because there's more home equity than that number. But in terms of tappable, how much they can go get, Americans can go get. The 48 million homeowners can go get $11 trillion of equity out of their home, and that can help alleviate those credit card debts and the total debts we just saw. So again, I would just tell you, we are doing some cash out refis. Again, it's yes, people are trading in their 3 and 4% interest rates, but overall, their interest payments are less each month if they were to take equity out of their home and use it to pay off that $1 trillion in credit card debt. So again, I don't love it either. I don't love people giving up at 3 and 4%. Yes, there are HELOC options like second liens, which we do absolutely explore when those make sense. We do those. But the reality is, it makes sense. A lot of times they do that, and it's just a numbers game to see what it tells us to do. This is frustrating, and we feel it. Buyers, 1 in 7 are canceling, which is basically like all-time high. So it's 1 in 7 folks. I want to say it's like 16%. I don't know if the math is right, but I've seen it as a stat before, and it's about 16%. And that's not, you'd think, oh man, because I think a normal market, if I'm not mistaken, is like 12% or something. So you think, oh, it's 4%. But look, it's a big number when you talk when you talk real numbers and real math to where it's like, oh man, that 1 out of 7 instead of 1 out of 6 or whatever it is. That's a lot of extra fallout that happens. Cancellations hit 20% in Atlanta. That's 1 out of 5. Tampa 1 out of 4. Orlando 1 out of 4. Or 1 out of 5. Sorry, 1 out of 5. 19%. Inventory's up, so it is kind of crazy out there. Listings hit almost $700 billion, and that means total in terms of price of the home. The part on the right that I want to point out, you see this, you're like, oh my gosh, that's so much higher than it used to be. Just remember how much homes have appreciated since COVID. So while we do have the lull down there in the 2020, 2022 range, if you kind of just figure out that, homes since COVID have basically increased, at least here in Dallas Fort Worth, 30-40% in value, like those numbers aren't that far off. To where, yes, it's a record, but I just want to make sure, don't get caught up in the headlines. Take half a second and think about it. You know, we do have more sellers, but this isn't as alarming because, again, house prices are just more expensive. So if you take that into consideration, it's not that dramatic compared to what it has been in years past. 44% of listings are sitting on the market for 60 days. Like a stable market is probably around that 60 days. I think I've heard and read and seen 62 days is kind of like, the normal for a stable parity kind of good market. So again, if 44% of them are hitting 60 plus days, again, does that mean 62? Does that mean 70? I know it doesn't mean 90 because if it did, the headline would say 90. So at the end of the day, I don't think these are as dramatic as they are making them out to be. Certainly they're new numbers, but if we're comparing 5 years ago as COVID, which is hard to believe, guys. COVID is 2020 and it's 2025. It doesn't seem like that long ago, but it also seems like a lifetime ago, depending on how you look at it. There are 330 billion worth of inventory sitting, which makes sense. If it's 44% are sitting longer than 60 days, 330 billion when we saw that previous number at 650 or whatever it was, this makes sense. But again, just going back to say, look, that kind of makes sense as far as just where we are and what the market looks like. Because compare these things to where, look at the one on the left again, you're still below 2019 levels as far as how many homes are sitting around for 60 days. So again, I still think we're good. It's just a matter of putting this perspective. And so of this, Dallas Fort Worth, we actually rank first in the listings nationwide. And you can say, man, that's terrible. That's not good. And there's a soft market. We're also one of the top like incoming migration cities. Like people are moving here in droves. So we are more affordable. Yes, we're building a lot of homes, but we still have a lot of folks, and our inventory is still not bad. I mean, again, the market doesn't have as many buyers as we'd like, but I don't think we're just oversaturated in sellers. I think we're probably hitting about that just right number. Dallas is 14th, the fourth bullet point on the left. We're set, or pardon me, 17th in the inventory growth. So we're behind Houston. Atlanta was number one, which was 41% growth in their listings, which is crazy to me. But again, I still think, yes, we're the highest. Yes, this is here. I don't think it's becoming this like big bubble. Maybe it will in 2, 3, 4 years from now. But I just still think we're doing all right, and builders are being responsible. At least the ones I know. Office towers. We've been saying this. I've been reading about it for 4 years about how the commercial mortgage-backed security market's in trouble. Again, I don't see it or feel it, but the reality is I just thought this was interesting. Apparently, office space delinquencies are 10%. That's got to hurt banks. So in the near future, 6 months, 12 months, we may be hearing more about banks, whether they're failing or having to be bought up or some of that nature. I mean, that's a big, big, big number. San Francisco is above 35% office availability. That's crazy. All right, so the feature of the week, we just did an awesome interview, and I mean this, an awesome interview. If you're an investor or know somebody who is or considering to become one, Kent, my new friend, we did an interview with him, property management for real estate investors. Go to mortgagemark.com and just search up property management, and this will pop up. And I'm telling you right now, Kent is the man. You need a property manager. I will tell you that as an investor. I was one, am one, but this was, I thought, a great interview. So check that out. And this dude, good for him, bad for him. Poor guy got diagnosed with something that may, cause future paralysis. So he sold everything he had, took his cat Phoenix, and decided to sail from Oregon down to Hawaii. So good for him. Congratulations. Wish him the best. And then lastly, if you're a seller, this is from the seller's perspective. The other buyer's loan, I guess technically it could be your buyer too, right? The other buyer's loan is not pre-approved. Ew. Love that. And then thank you to those that are giving us the love and shout and support on the testimonies. We do appreciate you. This one, I believe, was coming from a realtor of ours. So we just appreciate that. And thank you, thank you, thank you. And let's get social. Forward, share, subscribe, all the fun stuff you know what to do. As always, we certainly appreciate you watching. Hope you have a great and wonderful weekend. And let's just enjoy the weather and hook them. Tonight, the UT softball women play the winner-take-all championship game. So hook them and let's go. Have a great day and great weekend.